Welcome back to the channel. Silver is dead. That is the consensus. That is what they want you to believe. That is the exact synchronized narrative being pushed right now across the global financial media apparatus. But as an analyst of macroeconomic realities, I'm telling you to ignore the noise and focus on the mechanics of the machine. The financial system we operate within is essentially a cognitive architecture designed to maintain a specific frequency of belief. While the public is fed a continuous, looping story of precious metal weakness, something absolutely historic is happening behind the scenes. Something that has not happened in decades. The underlying structural integrity of the paper-silver market is fracturing. The COMEX silver open interest just collapsed to 101,000 contracts. That is the absolute lowest level in over 20 years. Let me repeat that so the gravity of the situation sinks in. We are witnessing the lowest level of open interest in over 2 decades. In the world of commodities, open interest represents the total number of outstanding derivative contracts that have not been settled. It is the lifeblood of the paper illusion. It is the artificial matrix layered over the physical world, and that lifeblood is currently draining away. Traders are no longer rolling their contracts forward. They are refusing to take the other side of the trade. They are simply walking away. Let us break down exactly what happened just yesterday. Total silver open interest closed at 101,275 contracts. The May contract alone lost 8,966 contracts. Over 50% of the remaining May open interest vanished into thin air. Of those contracts that closed, only 63% rolled forward. The rest, they completely walked away. They just quit the exchange entirely. 37% of traders recognized the artificial nature of the pricing structure and exited the paradigm. This is not normal. This is a mass exodus from the paper reality. The exchange is now threatening to break below the 100,000 contract psychological barrier. We are watching financial history happen in real time, a literal crack in the system. Yet the mainstream insists on looking the other way. Here is what should truly terrify the institutional short sellers, the architects of this paper reality. The Chicago Mercantile Exchange, the central node of this pricing apparatus, knows they have a massive systemic problem on their hands. So how did they respond to this unprecedented loss of liquidity? They slashed trading margins by 21% this week. For those listening who do not trade futures, the margin is the amount of capital required to hold a position. Non-hedger margins are now sitting at a mere 11%, and hedger margins sit at 12.1%. They are literally making it cheaper to gamble. They are desperately lowering the barrier to entry, hoping retail speculators or institutional algorithms will come back to the table to provide the liquidity they so desperately need to maintain control. Think deeply about what that actually means from a geopolitical and structural standpoint. The exchange that runs the global silver futures market is so worried about collapsing liquidity that they are cutting the cost by over 20%. They are begging market participants to come back. When has a major exchange ever slashed margins during a healthy market? The answer is never. They execute these emergency protocols when they are desperate, when they see the writing on the wall and realize the control mechanism is failing. But market participants have a memory. They remember what happened in November when the exchange halted silver trading during a major upside breakout, citing a supposed cooling issue in their data centers, a convenient glitch in the matrix. They remember February when silver broke above $94 in a massive surge, and the exchange shut it down again, twice. The exchange stepped in and stopped silver breakouts twice in a 6-month window by simply pulling the plug on the market. Institutional and retail traders alike are simply not coming back for a third time to be slaughtered. The architecture of the game was exposed, the curtain was pulled back, and now nobody wants to play. When the paper derivative market finally dies from a lack of participation, only the physical, tangible metal matters. As any geopolitical realist knows, there is nowhere near enough physical silver above ground to satisfy the global demand. The physical reality is about to collapse the paper simulation. Now, we must examine what the Federal Reserve just did, because this monetary policy shift forms the other half of the trap closing around the global economy. The Federal Open Market Committee held interest rates unchanged yesterday. That was entirely expected by anyone paying attention to the macro data. But it is the specific, deliberate change in their language that reveals their internal panic. Back in March, their official statement claimed that inflation remained, quote, somewhat elevated. Yesterday, they completely scrubbed the word somewhat from the record. Now, the official doctrine simply and bluntly states that inflation is elevated. Furthermore, they added critical context to the end of that sentence, stating that this is in part reflecting the recent increase in global energy prices. Let us translate that from central bank speak into geopolitical reality. Inflation is running much hotter and stickier than they projected. Energy prices are the core driver, and the central planners cannot do a single thing. Oil is pushing above $105 a barrel, and Brent crude just hit $110. The Strait of Hormuz remains a severe geopolitical flashpoint, heavily disrupted by regional conflict. Some energy analysts are calling this the most catastrophic, structurally entrenched energy crisis in modern history. And the Federal Reserve is completely and utterly powerless. You cannot print barrels of crude oil. You cannot mathematically lower the cost of logistics when global shipping lanes are under threat of physical kinetic warfare. All the central planners can do is sit in Washington, watch inflation burn through the purchasing power of the working class. 3 Federal Reserve officials actually dissented from the core narrative, not because they wanted to actively cut rates, but because they wanted the central bank to stop lying to the bond market. The December Federal Funds futures contract is now pricing in a 0% chance of a single rate cut this entire year. Let that reality settle in your mind. 0%. The broader market has finally woken up from the trance and given up. The Federal Reserve is hopelessly trapped in a box of their own making. They cannot cut interest rates because inflation is roaring back to life, driven by hard, tangible commodities. They cannot hike interest rates because the commercial real estate sector and the broader debt-based economy are actively buckling. They are frozen in absolute policy paralysis. The beast system of infinite debt is reaching its mathematical limit. Let me explain why this specific macroeconomic deadlock is incredibly bullish for physical silver and true hard assets. We have to look at the global reserve currency, the primary control grid of the financial matrix. The United States dollar index has been desperately trying to break above the 100 level for months, and it keeps failing miserably. If you track the data, there have been at least 4 major violent rejections at that exact level since May of last year. Every single time the dollar rallies up to touch 100, it gets slammed right back down by global market forces. The tensions in the Middle East spiked it briefly, but it was heavily rejected. The banking chaos in March pushed it higher as capital sought a perceived safe haven, but it was rejected again. 100 is the absolute psychological and technical ceiling for the dollar right now. The currency touches it and immediately reverses course. Currently, the dollar is trading around 98, stubbornly stuck in a channel between 96 support and 100 resistance. It is trapped in a tight, suffocating range, exactly like the Federal Reserve is trapped in its policy. As a realist, you must understand that the only thing propping the dollar up right now is an artificial geopolitical fear premium. When that acute fear fades, or when the world fully accepts a multipolar reality, the dollar falls. Dollar weakness is the single most incredibly bullish catalyst for precious metals. It is the most reliable, historically proven inverse relationship in the commodity sector. If the dollar finally breaks below that critical 96 support level, silver will explode upward. If the Federal Reserve eventually admits total defeat, sacrifices the currency to save the sovereign bond market, and starts cutting rates, the dollar falls, and silver explodes. Every single macroeconomic path, every single geopolitical outcome leads to the exact same mathematical destination. The paper paradigm fails, and physical reality reasserts itself. The setup has never been structurally better in our lifetimes. Let us conclude by connecting all of these macro data points and looking at the undeniable mathematical impossibility of the current financial system. We are not dealing in speculation, we are dealing in basic arithmetic. The registered physical inventory sitting in COMEX vaults, the actual silver available to settle these contracts, is sitting at just 76 million ounces. Yet, at the recent market peak, there were over 500 million ounces in outstanding paper claims. Stop and weigh those two numbers against each other. 76 million actual ounces versus 500 million paper promises. The math simply does not work. It is a physical impossibility. There is not enough silver in those vaults, or anywhere near them, to satisfy every single paper claim if the market calls their bluff. This entire system is nothing more than a massive, high-stakes game of musical chairs, and the music is rapidly slowing down to a halt. When enough industrial users, sovereign entities, and institutional whales demand physical delivery to secure their supply chains, the game abruptly ends. Someone gets left without a chair, and more importantly, without their critical silver. And when a default of that magnitude happens, the price does not just tick up 10%. It gaps up 50, maybe 100% overnight. That is exactly what happens, historically, when a massive systemic suppression mechanism breaks and the underlying physical reality is exposed to the daylight. So, how should you position yourself? Understand deeply that the current price action and the mainstream narrative of weakness are entirely manufactured. The fundamental supply and demand metrics have never been stronger in recorded history. If you're listening to the media and you believe silver is dead, you are exactly where the architects of the system want you to be. You are acting out the precise cognitive architecture they designed for you, scared, doubtful, and sitting quietly on the sidelines. While the biggest, most predictable wealth transfer in decades sets up right in front of you. Do not allow yourself to be a victim of the narrative. Transmuting this knowledge into action requires a shift in your own mindset. Watch the data. Watch for the COMEX open interest to break below 100,000 contracts. Watch for the dollar index to officially break and close below 96. The smart money, the sovereign wealth funds, the central banks in the East, they are not fooled by fake headlines. They are accumulating physical assets. Be smart money. Taking control of your wealth is the first step in taking control of your reality. Because of the recent suppression of this kind of truth-telling, the true community building happens over on Patreon. Furthermore, if you are ready to explore the deeper mechanics of reality creation, neuroplasticity, and breaking out of these mental systems entirely, make sure you are subscribed Faultline Finance channel. Make sure you share this information with someone who needs to hear the truth. Stay vigilant, secure your assets, and I will see you in the next analysis.